Yeah, I think the biggest thing I noticed here is August was slightly negative after revisions. So you had some downward revisions. The 3-month average is still pretty meager, 62,000 or so.
Yeah.
And the direction of travel on the unemployment rate, it appears to be going higher. So we're now 4.4. I think headed to 4.5, 4.6. So I think this does keep the possibility of a rate cut definitely on the table. You see that reaction initially in the bond market, particularly in the front end. So that's the initial read.
And Paul, the single statistic here, which Cleveland, of course, alludes to, is a survey on change in non-farm payrolls for August was 22,000, the reality rather, and it's a negative statistic.
Yep.
It's negative 4,000
on a revision
on the August report. That's emotional. That negative number is emotional.
Absolutely. How about on the looking at the wage market here, Jeffrey? On an annualized basis, average annually earnings up about 3.8%. That holds pretty steady. So if you've got a job, you're getting paid for it, it seems like.
Yeah, I think that's the positive take here. You still have some modest payroll growth on the 3-month average. You still have wage growth. So overall aggregate income, the consumer still has some spending wherewithal. So this is not a doom and gloom type scenario. Sorry for the bears out there. It's going to create a little more uncertainty over the next few months as we continue to digest this. But it's not a slam dunk data report that points to a recession.
Yep. So what do you think? What are some of the real-time data telling you about kind of where we are today with the labor market? Is this number reflective, or is it just a little bit?
No, I think we do think that all the signs that we've seen through October, November data would point to a higher unemployment rate than 4.4. So something like 4.5, 4.6 would make sense. So that's a bit of a concern. I think also the layoff announcements that we've seen. That's definitely captured our attention. So it's very bond bullish environment. Government bond yields probably on a 12-month horizon are quite a bit lower if we're right.
I look, Jeffrey Cleveland, at this, and I've alluded to this with a couple of conversations this morning. And I'm sorry, folks. This goes back to what you study at Claremont in school.
Wow.
No, but it's a history, Jeffrey. How can the Fed ignore a fragile labor economy? I get the inflation this, inflation that, fancy mathematics and all that. But the fact is the labor economy's a bit fragile. That's got to be top of list.
I think so. But what does history tell us about the Fed? Usually they're reactive, not proactive, right? So there is an inertia factor, if you will, or a lag between when we think we see something in the data and policymakers take action. We definitely saw that in 21 and 22. I think the Fed was behind the curve there. So it wouldn't surprise me if they were a little sluggish. There are also differing opinions, Tom. I mean, when I talk to clients all year, it's been inflation. If you are able to push back on one of the inflation theories, they'll quickly come up with another. It's been like that all year. So that's just the focus. And with with inflation still a little bit above target, people still have that mindset. So you need a clear indication to the contrary to really get people over onto your view that maybe labor market is the bigger issue.
All right, Jeffrey. So we got a view here on the labor market today. How about inflation, the other part of the Fed's mandate? What's your view there?
Not worried about it.
Okay.
When you exclude the tariff pressure, inflation on our view is 2.4 right now, year over year on core PCE. I mean, more or less, if you round that down, it rounds to 2%, I think. So we're at target if you exclude the tariffs, and we don't think tariffs are an enduring inflation feature. It's a one-time pop to the price level. So we're not worried. And then we see more scope for disinflation, Paul, next year. I think you could see it on non-housing services and importantly on the housing component of inflation. So we'll see lower inflation. We could get back to 2% inflation sometime next year, maybe even below 2%, guys.
Jeffrey,
it'll be interesting.
I want you to do a nail Ferguson. If we get a 1/4 point rate cut, what actually happens?
Well, this is a common thing people say to me, Tom. They say, 1/4 point won't do anything for the labor market. And my response to that is, well, why don't we just try anyway? Let's just give it a chance. I mean, it does have an impact. if the bond market senses out that the direction of travel for the overnight rate is, another 100 basis points lower or more over the next year, that will feed through into 10-year yields. That will affect corporate borrowing costs. That will also feed through into mortgage rates. I think
that's
Paul
what the
earlier
economist
mentioned.
Paul Sweeney says.
Yeah.
Exactly. Yeah, exactly. So it will have an impact. It's not just the 25 basis point fine tuning. It's more than that.